Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to explain why I believe Alphabet or Google stock is undervalued now. Just to give you some context, right before I started making this video, Google made a huge mistake by releasing Gemini's AI image generator too early without thoroughly testing it first. For example, if you ask Google Gemini to give you pictures of the US founding fathers, Google Gemini will give you a more diverse group of the US founding fathers, but this is not historically accurate. Or if you ask Google Gemini to give you pictures of German soldiers in the 1940s, Google Gemini will give you a more diverse group of German soldiers. Again, this is not historically accurate at all. Google Gemini wants to give users more diverse pictures that are less biased and less stereotyped. In this case, Google Gemini created these pictures that are more racially diverse, but these pictures are not historically correct at all. Google stock has dropped quite a lot recently because investors are concerned that Google is falling behind Microsoft and OpenAI in AI, specifically generative AI and advanced AI models. Microsoft is the largest investor in OpenAI. Many investors worry that ChatGPT and Microsoft Copilot may eventually reduce Google's dominance in the search market. Search is Google's most important business. This is why Google's market cap has not grown much recently compared to Microsoft and Amazon. In fact, Amazon has surpassed Google in market cap recently. So in this video, I'm going to explain why I believe Alphabet stock or Google stock is undervalued now. First, I will give you a quick stock portfolio update. Then I will talk about Google's biggest short-term risk and headwinds, Google's long-term growth prospects, Google stock valuation, and will I buy Google stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing and stock analysis videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing in for the long term, follow my personal stock portfolios, watch my investing tutorial videos, and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about Google's biggest risks and headwinds, I want to give you a quick stock portfolio update. In many of my videos, I always use this portfolio to show you my investing strategy over time. I also have other portfolios that have the same stocks and the same investing strategy as this portfolio. My long-term investing strategy is this. I like to invest in the best Y-mode businesses that are undervalued. I always wait until the stock is fairly valued or undervalued first before investing in it. Then I like to buy and hold it for the long term, so the business can grow exponentially over time. For example, right before making this video, I bought more Apple shares because Apple has dropped a lot recently. Based on my intrinsic value calculation, I believe Apple is fairly valued or slightly undervalued again. So I like to be very greedy when others are fearful. I also bought more Google shares recently. I believe Google is still undervalued at the time making this video. I will show you how to calculate Google stock's intrinsic value near the end of this video. You may notice that this portfolio has many outstanding semiconductor stocks and AI stocks such as AMD, Nvidia, ASML, and TSMC. This is why this portfolio is performing very well and it's outperforming the S&P 500 by a large margin. I expect this portfolio will grow to well over $1 million over time. Over the next several weeks, I will transfer this portfolio to another online broker because this online broker will be acquired by another bank. So starting next month, you will see this portfolio separated into several accounts. The online broker I'll be using does not have an overview page that combines all the accounts together, but all the stocks will still be the same. I'll keep you updated. Now, going back to Google, I want to talk about the biggest short-term headwinds and risks first. At the time of making this video, I believe Google's biggest headwind is Google Gemini. Based on what I know, Google Gemini is behind OpenAI, Midjourney, and Stable Diffusion when it comes to AI image generation. I said this earlier, Google rushed out releasing Gemini's image generator without thoroughly testing it first. Now, Google CEO has apologized for missing the mark and offending many users. Google stated that it will re-enable Google Gemini's image generator in a few weeks after the company fixes most of the diversity issues. So why is Google Gemini very important to investors, and what really went wrong? Google's management said this. So what went wrong? In short, two things. First, our tuning to ensure that Gemini show a range of people failed to account for cases that should clearly not show a range. And second, over time, the model became way more cautious than we intended and refused to answer certain prompts entirely, wrongly interpreting some very anodyne prompts as sensitive. These two things led the model to overcompensate in some cases and be over-conservative in others, leading to images that were embarrassing and wrong. First of all, many investors are worried that Google has fallen behind in AI compared to OpenAI, Microsoft, and other AI companies. OpenAI seems to be well ahead of Google in large language models, AI chatbot, AI image generator, and AI video generator. I'll give you an example here. I asked ChatGPT to create an image of the US founding fathers. This is created by GPT-4. It's not perfect, but it's more accurate than Google Gemini's image generator. Again, Google Gemini created this US founding fathers image. You can see one of them is not correct. According to this article, Meta AI also has the same issues as Google Gemini if you ask Meta AI to create an image of the US founding fathers. So Google Gemini is not the only AI model that has the same problems. I believe the market overreacted to Google Gemini's issues. None of these large language models or LLMs are perfect. AI models can make many mistakes and have a lot of biases depending on the training data that's used and the algorithms behind them. If you use ChatGPT and other AI models, you will know that they can hallucinate and make up incorrect answers. This is why it's still much better to use the Google search engine if you want the fastest and the most accurate answers. Many investors are concerned that AI chatbots such as ChatGPT or Microsoft Copilot may eventually reduce Google's market share in search. According to Gartner, the company believes that by 2026, traditional search engine volume will drop 25%, with search marketing losing market share to AI chatbots and other virtual agents. I believe this prediction is completely wrong because Gartner assumes that Google will not innovate and assumes that Google will not introduce new generative AI features to its Google search engine. Gartner also assumes that AI chatbots and AI agents will be able to produce very fast and accurate answers just like Google. Google is already implementing more generative AI features in its Google search engine. For example, we will likely see more generative AI content on top of the traditional search content. Of course, Google will optimize ads for generative AI content to make ads more effective for advertisers. Here's another thing we should consider. When you think about search, you will likely think about Google first. And when you think about online videos, you will likely think about YouTube first. Google has around 90% of the global search engine market. YouTube is the second largest search engine in the world after Google. Most people use Google every day because Google is very easy to use and it's free. Google is much faster than most search engines. More importantly, Google tends to give the most accurate answers to most search queries. Google has the most web data and the most user data. This is why Google can often give the best answers to user search queries and help advertisers target their ads to the right users. Here's an important fact. Google processes about 8.5 million searches every day, or approximately 2 trillion searches every year. It will be extremely expensive for OpenAI and other AI companies to process the same amount of search queries, or even 25% of Google search queries every day. AI inferencing is a lot more expensive than traditional search engine queries. This is why OpenAI is charging users $20 per month if they want to use OpenAI's latest AI models. In comparison, Google is free to use. This is why I believe Gartner is completely wrong about AI chatbots and AI agents taking 25% of the search engine volume by 2026. Microsoft has tried to compete with Google in the search market for many years, but Google still has a monopoly in the search market. For example, Microsoft introduced Bing with an AI chatbot in early 2023. Now Microsoft AI chatbot is called Copilot. OpenAI released ChatGPT in November 2022. Many people believe that ChatGPT may take away Google's market share in search. If you look at these stats here, you can clearly see that Microsoft's Copilot and ChatGPT have not reduced Google's search market share at all. Google still has around 92% of the search engine market. Google owns Chrome, which is the most popular web browser in the world. By default, Chrome uses the Google search engine. Most people don't change their search engine on Chrome. Google pays Apple billions every year to be Apple's default search engine. This gives Google a huge competitive advantage compared to Microsoft and OpenAI. I don't think Apple wants to change this partnership with Google because this partnership is very profitable for Apple. Google owns the Android mobile operating system, which has the largest market share in mobile devices. This is another huge competitive advantage for Google because Android tends to encourage users to use the Google search engine, YouTube, Chrome, Gmail, Google Maps, and many other Google applications. This is why I believe it will be extremely hard for OpenAI, Microsoft, and other AI companies to take away Google's search engine market share. If they want to compete with Google in search, these companies need to compete with Google's entire ecosystem, such as Chrome, Android OS, YouTube, and Gmail, and not just Google's search engine. Of course, every company has its own issues. Google is not perfect. Google will likely face more antitrust issues and get more fines from regulators going forward because Google has a near monopoly in search and other services such as online advertising and mobile operating system. Google is not the only company that's facing antitrust issues. The largest mega cap tech companies such as Microsoft, Apple, Amazon, and Meta also have their own antitrust issues. I want to show you these financials here. It shows that Google has a very strong balance sheet with minimum debt even if Google has to pay billions in antitrust fines. For example, at the time of making this video, Google has 111 billion in cash equivalents and 25.7 billion in total debt. This means Google can pay off all its debt and still have around 85 billion in cash left. Let's talk about Google's long-term growth prospects here. If you look at these past financials, you can see Google has had very consistent revenue growth, operating income growth, and free cash flow growth over the past 10 years. This is my prediction. As long as Google continues to dominate the search engine market and has around 90% of the search market, I believe Google will continue to earn higher revenue, higher operating income, and higher free cash flow over time. This is because the number of search queries will continue to increase every year, and advertisers will continue to spend more money on online advertising over time. Google, Meta, and Amazon are the three biggest online advertising platforms. They have the most monthly active users. Google, Meta, and Amazon will continue to earn more advertising revenues over time because advertisers are continually shifting more advertising budgets from offline to online platforms now. Google earns most of its total revenues and operating income from advertising. For example, according to the latest quarter here, advertising contributing 76% of the total revenues. Google subscription services and apps contributed about 12.5% of the total revenues, and Google Cloud contributed about 11% of the total revenues. The most important part is this. During the most recent quarter, Google services contributed almost all the operating income. Google Cloud is starting to be profitable. Going forward, Google's advertising business will likely have a much lower revenue growth rate than before because the Google search engine, YouTube, and Google Network are very mature businesses already. However, these businesses will still contribute the most operating income to Google. They are Google's most important and most profitable businesses. I believe Google subscription services and Google Cloud will be Google's biggest growth opportunities going forward. These businesses are still in the very early growth stage. Let me explain here. Google understands that generative AI and other AI breakthroughs such as AGI will be the biggest growth opportunities for the company going forward. Google understands that Google Cloud is still in the early growth stage and it will eventually become a lot more profitable over time as it scales more, similar to Amazon AWS and Microsoft Azure. This is why Google is increasing its investments in AI R&D and AI infrastructure. I want to show you this market share trend here. The biggest three cloud providers, Amazon AWS, Microsoft Azure, and Google Cloud, have dominated the cloud infrastructure market for many years. If you combine the big three's market shares, they have around 67% of the total market. Microsoft's cloud business has had the fastest growth rate in recent quarters compared to Amazon AWS and Google Cloud because Microsoft is benefiting the most from its investments in OpenAI. Right now, there's an enormous demand for the most advanced AI models and generative AI applications. This is driving a lot of businesses to Microsoft. Google Cloud is still much smaller than Amazon AWS and Microsoft Azure. This is why I believe Google Cloud will be one of the biggest growth opportunities for Google going forward, and AI will continue to be one of the biggest growth drivers for Google Cloud going forward. According to Synergy Research Group, the company expects that the cloud infrastructure market will soon grow from 270 billion in 2023 to 500 billion a year. And AI will be one of the biggest growth drivers in cloud spending. This cloud spending trend will benefit Google Cloud over the long term. Other than Google Cloud, I believe Google's second biggest growth driver is its subscription business. Google's management said this in the most recent earnings call. Within subscriptions, platforms, and devices, our total revenues from subscription products reached $15 billion for the full year 2023, driven primarily by substantial growth in subscribers for our YouTube subscription offerings. At the time of making this video, YouTube has over 2.7 billion active users and 100 million premium users. I believe YouTube will continue to have more users over time because more people are watching more videos online. I also believe that YouTube will continue to have more premium subscribers over time because many people don't like to watch ads, so they are willing to pay for the premium service. Other than YouTube Premium, Google is offering a $20 per month subscription plan that will allow users to have access to the most advanced Gemini AI model. This is similar to ChatGPT and Microsoft Copilot subscription plans. Right now, it's still too early to tell whether Google's AI Premium plan will be successful, but if I have to make an educated guess, I believe many users will pay for Google's AI Premium plan once Google Gemini becomes much better over time. Google just needs to include many other perks such as more cloud storage or combine this AI Premium plan with YouTube Premium. As long as the price is reasonable, I believe many users will pay for this AI Premium service once Google Gemini gets much better. I always use Seeking Alpha's consensus revenue forecast when I analyze stocks. I believe this is one of the most useful tools because it shows each company's expected growth rates going forward. If you want to see these consensus revenue estimates, I have posted an affiliate link in the video description. Take a look. Going forward, Google's revenue is expected to grow between 8% and 12% each year over the next several years. I believe these growth estimates are a bit conservative. I don't think they consider Google Cloud's growth potential in generative AI applications and AI workloads yet. In terms of EPS forecast, Google's EPS is expected to grow between 13% and 18% each year over the next several years. I think these EPS estimates are more reasonable because Google will likely reduce more operating costs going forward, similar to Meta. Google's operating expenses are expected to grow slower than its revenue growth going forward. Let's take a look at this valuation comparison here. These are the Magnificent 7 stocks: Google, Microsoft, Meta, Amazon, Nvidia, Apple, and Tesla. If you compare the Magnificent 7 stocks forward valuations here, you will notice that Google's forward PE and forward EV to EBITDA are lower than the other companies' forward valuations. I believe this suggests that Google is likely undervalued at the time of making this video. I want to show you how to calculate Google stock's intrinsic value here, so you will know when Google becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Google's intrinsic value as its future free cash flow discounted to the present day. I used a discount rate of 9.6% here. You can use a higher discount rate here if you want to be more conservative. Based on the short-term risk and the long-term growth prospects I talked about earlier, I believe Google's revenue will grow at a compound annual growth rate CAGR between 9% and 11% annually over the next several years. I believe this revenue growth forecast is reasonable. Let's go over these three case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting Google's revenue will grow at a CAGR of 9% over the next several years. If we forecast Google's free cash flow over the next 5 years and discount the free cash flow to the present day, Google's intrinsic value should be around $1.97 trillion for the entire company, or $156 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting Google's revenue will grow at a CAGR of 10% over the next several years. Then Google's intrinsic value should be around $2.05 trillion for the entire company, or $162 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that Google's revenue will grow at a CAGR of 11% over the next several years. Then Google's intrinsic value should be around $2.1 trillion for the entire company, or $169 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Google's intrinsic value should be around $163 per share. I also used the forward price to sales valuation model here to estimate Google's intrinsic value, which should be around $2 trillion for the entire company, or around $160 per share. If we take the average of both valuation models here, I believe Google's intrinsic value should be around $161 per share. Just to compare, Morningstar gave Google a much higher fair value of $171 per share. This means I believe Google is undervalued at the time of making this video. So will I buy Google stock? Yes, I will continue buying more Google shares over time, as long as the company is still undervalued, below its intrinsic business value. I believe Google has many outstanding businesses and services. For example, I like Google, YouTube, Chrome, Android OS, Google Cloud, Gmail, and Google Gemini. Google has a near monopoly in many services, including its search engine, the Android OS, Chrome, and YouTube. This is my prediction. I believe it will be extremely hard for Microsoft, OpenAI, and other AI companies to reduce Google's market share in search. These AI companies will need to compete with Google's entire ecosystem and not just Google's search engine. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. I think it's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.